Ladies and gentlemen, silver stackers, friends who believe in something more than just paper promises, I did the math, I ran the numbers, I looked at silver through every lens: inflation, industrial demand, historical precedent, valuation ratios, and what I discovered is frankly unbelievable. Silver stackers, I want to take a step back and share what I've been seeing, because when I really sat down, did the math, and pulled apart the numbers, the conclusion I came to surprise even me. Silver is not just another asset to park some savings in. It is a metal that moves in patterns driven by forces far bigger than any one individual, and if you study those forces, you start to see why what's ahead may be far more dramatic than most people are ready for. When I examined silver across decades, what stood out most clearly was the difference between what it looks like on the surface and what's actually happening beneath. The price charts show big swings, long stretches where silver seems flat or disappointing, then sudden bursts of upward momentum that can change the picture entirely. If you only look at the nominal price, you can be misled into thinking silver has underperformed. But when you adjust for inflation, when you strip away the noise and look at real purchasing power, a different story comes through. Silver has not just preserved wealth in certain cycles, it has expanded it dramatically. That's not theory, it's historical fact. The big driver here is silver's unique role. Unlike gold, which is mostly a store of wealth and a monetary metal, silver lives in two worlds. It is both a precious metal and an industrial necessity. Think about what that means. On one hand, investors rush into silver during times of uncertainty, creating price spikes. On the other, industries are quietly consuming massive amounts of silver in products that define modern life. Electronics, medical instruments, solar panels, and increasingly in green technologies that governments are subsidizing worldwide, those two worlds don't just coexist, they collide, and when they do, the demand side of the equation can overwhelm available supply. On the supply side, silver is not as abundant as many assume. It is mined largely as a byproduct of other metals like copper, lead, and zinc. That means silver supply doesn't simply rise when its price rises because the production is tied to the economics of other metals. If demand accelerates, but supply remains constrained by these structural factors, the imbalance can be profound. That's why silver has such sharp, explosive rallies. The supply chain doesn't flex easily. And so, when investors and industries both pull at once, prices can leap. Another way to frame the opportunity is through the gold to silver ratio. Historically, the long-term average ratio has been far lower than where it stands today. In the past, silver traded closer in value to gold, but in recent years, the gap has stretched wide. When these gaps open, history shows that they don't last forever. Ratios tend to mean revert. That doesn't necessarily mean gold has to fall. It can also mean silver catches up by rising, and when that adjustment happens, it can be violent. The math of the ratio suggests that silver is significantly undervalued relative to gold, and if the ratio simply moved back toward historic norms, silver's price would need to climb sharply. Now, none of this is to say the path is smooth. Silver is one of the most volatile assets you can own. It can swing by double-digit percentages in short spans of time. That volatility discourages many people. But in truth, it's simply part of its nature. If you approach silver with a short-term mindset, you're almost guaranteed to be frustrated. If you approach it with the patience to let cycles play out, the volatility becomes less of a threat and more of an opportunity. Volatility is the price you pay for the potential of asymmetric returns. When I put all of this together, the inflation-adjusted data, the industrial and monetary duality, the structural supply limits, and the distorted ratio to gold, the picture that emerges is extraordinary. Silver is sitting in a position where the forces of history, economics, and technology are converging. It is underappreciated, undermed, and misunderstood. That's why when I ran the numbers and looked at where it could go, I found the results almost unbelievable. But here's the perspective I want to leave you with. Don't let the drama of the short term blind you to the long-term reality. Markets move in cycles. Human psychology swings from fear to greed and back again. Silver will reflect those swings, but beneath that surface, the fundamentals remain. Demand is rising, supply is constrained, valuations are stretched. Those are the facts, and facts over time exert their weight on price. So if you're stacking silver today, understand why you're doing it. It's not about tomorrow or next week. It's about having the patience to hold something real, something that has endured for thousands of years, while recognizing the unique dynamics of the world we live in now. Silver is both ancient and modern, both stable and volatile, both wealth and utility. That combination is rare, and when the math points in the same direction as the fundamentals, you don't ignore it. You prepare for it. That's why I say what I found is unbelievable, not because it defies reason, but because the logic is so clear, and yet so few are willing to see it. For those who do, the future may not just protect your wealth, it may transform it. When I look at silver, I don't see it the way most people do. A lot of people think of it as a speculative metal, something to hold when gold feels too expensive, or as a shiny collectible that's nice to stack in a safe. But when I strip away the noise, when I actually put the numbers side by side and away the underlying drivers, the picture that emerges is very different. What I found is that silver sits at the crossroads of monetary history, industrial necessity, and market psychology. And when I ran the math, the conclusions weren't just surprising, they were almost hard to believe. The first thing I focus on is how silver has behaved over long stretches of time. If you only look at nominal price charts, the picture is erratic, long flat lines punctuated by sudden, almost violent upward spikes. That sort of chart leads many people to dismiss silver as unreliable. But when you account for inflation, when you measure silver in real purchasing power, you find that it has managed to not only protect value, but in certain cycles to multiply it. The key is that those bursts, those unbelievable spikes more than make up for the dull stretches in between. If you're willing to step back and see decades instead of months, the math changes your perspective entirely. Then there's silver's dual identity. Unlike gold, which is driven primarily by monetary and investment demand, silver has a foot in two camps. It's a hedge, yes, but it's also a vital industrial input. Every smartphone, every solar panel, every medical device that relies on conductivity is quietly consuming silver. That means even in times when investors are ignoring it, factories, tech companies, and energy producers are not. This steady drain from industrial usage creates a baseline demand that doesn't go away. And when investors wake up and pile on top of that, supply simply doesn't have the flexibility to keep up. That's when we get those explosive rallies. On the supply side, this is where the math gets especially interesting. Silver isn't mined in isolation the way gold is. The majority of silver is produced as a byproduct of mining other metals, copper, lead, zinc. That means the supply of silver doesn't increase just because its price rises. If copper mining slows, silver output slows with it. If environmental regulations tighten, silver availability gets squeezed indirectly. So, when demand surges, whether from investors or industry, there isn't a clear mechanism to meet it quickly. The rigidity of supply is what sets the stage for volatility. That volatility is frustrating if you're trading it, but it's an opportunity if you're investing with patience. Another lens that can't be ignored is the gold to silver ratio. Right now, gold trades at a historically high multiple to silver. This ratio has fluctuated widely over centuries, but it tends to revert back toward a long-term average. When it stretches too far, it doesn't stay there forever, and the way it reverts is usually not because gold falls, but because silver climbs. If the ratio, even partially corrected to its historical mean, silver would have to rise substantially from current levels. This isn't speculation, it's mathematics combined with history. Now, does that mean silver is guaranteed to rise in a straight line? Of course not. Silver is one of the most volatile assets you can own. It will test your patience, it will move sideways for years and then leap when people least expect it. This is why most people get shaken out before the real payoff comes. But if you understand the underlying drivers, you don't let short-term fluctuations distract you from the long-term setup. The volatility is the price of admission for the potential rewards. When I added up all these pieces, the real inflation, adjusted performance, the dual role as both money and industry, the constrained supply mechanics, and the distorted ratio to gold, the conclusion was undeniable. Silver is undervalued, misunderstood, and underappreciated, and when those conditions exist, the eventual rebalancing tends to be powerful. That's why the math looked unbelievable at first glance. Not because it was wrong, but because the implications were so outsized compared to how the market currently treats silver. What this means for anyone stacking today is simple, but not easy. You need to have a clear reason for why you hold it. You need to recognize that it won't always feel rewarding in the short term, and there will be times when you question why you even bothered. But if you zoom out, if you align your expectations with the cycles that govern this market, silver has the capacity to do things few other assets can. It protects, it surprises, and occasionally it transforms a portfolio. So when I say I've done the math and the results are unbelievable, it's not a dramatic statement. It's just the truth of what happens when demand meets constrained supply, when history rhymes with the present, and when patience intersects with opportunity. For those who are willing to see it that way, silver isn't just a stack of coins or bars. It's a long-term strategic position in a world where few things are as real, as tangible, and as necessary. When I break things down to fundamentals, silver tells a story that is both familiar and surprising. On the surface, it looks like a commodity that has underperformed for long stretches, punctuated by occasional moments of excitement. But once you dig deeper, once you look at the data across cycles and understand the underlying drivers, the reality is that silver has qualities that are often overlooked, and the math behind its value points to outcomes that most people would dismiss as unrealistic. The truth is those outcomes are not only possible, they are probable if you understand how cycles play out. The first point to grasp is the difference between nominal and real returns. Many look at silver's price over decades and conclude it hasn't done much, but they forget to adjust for inflation. When you measure silver in terms of purchasing power, you see it has held wealth across generations, and in specific periods multiplied it dramatically. The big takeaway from the math is that silver doesn't steadily grind higher year after year like an income-producing asset. Instead, it compresses long stretches of stagnation with sudden bursts of exponential growth. That uneven rhythm is frustrating for those who want consistency, but it's precisely that rhythm that creates the outsized opportunities for those with patience. Next, silver's dual identity is critical. It is both a monetary metal and an industrial metal. This is not a trivial distinction. It changes everything. As a monetary metal, it responds to fears of inflation, debt crisis, and monetary debasement. As an industrial metal, it is consumed by modern economies in ways that are non-negotiable. Electronics, medical technology, solar panels, and advanced manufacturing all depend on silver's unique properties. That means demand doesn't vanish just because investors lose interest for a while. Industry continues to pull it from the market, steadily draining supply. Then, when investors eventually wake up in return, the market faces a supply-demand imbalance that has no easy fix. The supply picture reinforces this. Unlike gold, which is mined primarily for its own sake, silver is mostly produced as a byproduct of other metals that makes silver supply chain inflexible. If silver prices rise sharply, production doesn't automatically rise to meet that demand because the underlying mining activity is tied to the economics of copper, lead, and zinc. If those industries are weak, silver supply can actually shrink even as demand expands. This rigidity is why silver is prone to explosive price spikes. Markets that cannot adjust supply easily end up repricing violently when pressure builds. The gold to silver ratio adds another layer. Historically, the ratio has averaged far lower than today's levels. Right now, silver is priced at a deep discount to gold compared to those historical norms. Ratios don't stay stretched forever. They eventually revert, and when they do, it often happens quickly. The math of a reversion suggests silver could appreciate significantly without any change in gold's price. If gold also rises, the potential magnifies. This isn't speculation. It's simply recognizing that valuation gaps tend to close over time. The challenge, of course, is volatility. Silver is one of the most volatile assets on the planet. It can move up or down by double digits in short bursts, which unnerves many investors, but volatility doesn't change fundamentals. It only shakes people out of positions before the fundamentals play out. If you see volatility as a cost of entry rather than a sign of danger, you can view silver differently. The mathematics of its history show that the big payoffs have always come after long volatile consolidations that tested conviction. When I put all these elements together, the inflation-adjusted returns, the industrial demand that steadily eats away at supply, the inflexible production structure, and the historically stretched ratio to gold. Picture is compelling. It suggests silver is undervalued in ways that markets won't ignore forever. What's unbelievable at first glance is how wide the gap is between perception and reality. Most people dismiss silver because they focus on its periods of underperformance. But that is exactly what sets the stage for outsized gains when conditions align. The takeaway is simple: silver demands patience. It demands that you understand why you hold it. It demands that you accept volatility as part of the journey. But if you can do that, the probabilities point in your favor. The math doesn't lie. When demand grows, when supply is constrained, and when valuations are out of balance, adjustments happen. And when adjustments happen in silver, they aren't subtle, they are transformative. So when I say I did the math and what I found was unbelievable, it's not hyperbole. It's the recognition that silver is positioned at the intersection of forces that are larger than any individual monetary shifts, technological revolutions, and historical cycles of valuation. Those who understand this won't be surprised when silver moves in ways that most people never saw coming. They'll be prepared because they recognized the signs early and trusted the numbers to tell the real